Questions continue to linger over how markets will react to such geopolitical risks. For more on the Russia-Ukraine crisis and more broadly risks for markets, we're joined by Tony Dwyer, Canaccord Genuity Chief Market Strategist. Tony, this kind of reminds me of maybe summer surprises we've gotten in the past, right? I think about the Brexit vote. I think about the downgrade of U.S. debt, for example, as things that happened in the summer months and kind of shook things up. This didn't feel like that was it, right? But I wonder kind of what's on your unexpected risk radar right now.
Julie, I think what's on the unexpected risk radar is that this is a normal economic slowdown driven by credit contraction that happens from an inversion of the yield curve, which happens because the Fed increases interest rates to a level that suggests it. And I think, the Russians, the TVs and all the shows are filled with people that have all of a sudden become a Russian expert. I'm not going to be one of them. I didn't see it coming. I have no idea what it means. What I do know is that it's if companies and lenders will not lend money to lose money, and with all the yield curves inverted, that ultimately should have some kind of impact on economic growth and therefore the markets.
But Tony, the conflict, of course, is ongoing between Ukraine and Russia. So where does that stand in terms of what we should be monitoring when it comes to different asset classes? Like, should we be paying more attention to commodities in light of the ongoing conflict?
Well, Diane, it's not having an impact that I can tell. So it's not like something happens in Ukraine and all of a sudden the markets react to it. Right now, I hate to say such a tragedy is on the back burner, but that's not what is driving the investment landscape. So we could write about it, we could talk about it, but ultimately it comes down to the action. And I don't really sense that there's any major action in the backdrop because of what's taking place in Ukraine and Russia. So that leaves us again, going back to the, what if the difference this time is this just an old school recession developing that's based on not a credit catastrophe, but just a shrinking of credit? And ultimately, that leaves you in a market that is elevated on the hopes for a soft landing that it just does. The data that I'm looking at just doesn't seem to suggest.
Well, I was looking at the latest MLive survey from Bloomberg, and they surveyed people as to what the S&P 500 is going to be at the end of the year. I think it was something like 4,200. So not seeing the rally continue. Where are you on that front?
Well, Julie, I think, we've done this for a while. I mean, what market are we talking about? Are we talking about the top 8 stocks? Or are we talking about everything else? Because if you're looking at everything else, it's already had a pretty tough start to the year. When you think about the Dow Jones Industrial Average is up 1.75%, and that cash is outperforming actually through the first half of the year, the annualized return of a lot of the major indices outside of the mega cap weighted indices. It's been a more uncertain environment for the average stock than it has been for those mega cap stocks that are really driving the performance of the indices.